Welcome to What the Sigma. I'm Chad Stacks. Today we're digging into the Fed's latest hold. 9-3, fifth straight, looked calm. It wasn't. 3 dissents broke against an easing bias while inflation has been above target for over 5 years and a war is spiking oil. We're going to show you why the bond market isn't pricing Jerome Powell's successor. It's pricing a barrel of crude. And what that means for your rate path, your credit spread, and every over-levered company staring down a refinancing wall. Every headline told you the Fed held steady, and every headline read it like patience. 9-3, fifth straight hold at 3.6%. Calm. Measured. A central bank waiting. Except the 3 people who broke ranks weren't begging for cuts. They dissented against leaving an easing bias in the policy statement. Into inflation that has now run above the 2% target for over 5 years. Beth Hammock out of Cleveland, Neel Kashkari out of Minneapolis, Lori Logan out of Dallas. 3 regional presidents standing up against leaving an easing bias in the statement while a war is spiking oil. This is not a Fed being patient. This is a Fed being dragged toward the exit by a supply shock, and the split tells you exactly which way the door is swinging. Let me show you the machinery, because the mechanics here are cleaner than anyone is giving them credit for. The controlling variable in this decision is no longer domestic demand. It is not the labor market. It is not consumer spending. It is a strait of water. The Iran war widened, the Houthis are threatening the Red Sea, and Brent crude topped $100 a barrel last week. A large share of the world's seaborne oil moves through the Strait of Hormuz, and when that flow gets a risk premium stapled to it, the entire American yield curve reprices. That is where we are. The most powerful central bank on earth is now a passenger, and the oil tape is driving. And here is the part the market mechanics reporting nailed, the read that actually holds up under a second look. The bond market is not pricing the Fed. It is pricing the barrel. Watch the tape from the session before the decision. Brent fell 4.23% to 84.58. WTI down 3.68% to 79.55, both on ceasefire hopes. And in lockstep, the 10-year yield dropped 3.9 basis points to 4.602, its third straight daily decline. The 30-year to 5.095, the 2-year to 4.275. A lazy analyst looks at yields falling into a Fed meeting and calls it dovish positioning. That is wrong. The yields fell because oil fell. Joanne Bianco at Bond Block said it plainly. Lower oil, less forward inflationary pressure, so rates back off a bit. The war risk premium is now the marginal price setter of the long end of the Treasury curve. Not Jerome Powell's successor, not the dot plot. A barrel of crude and whether the shooting stops. Want proof it is oil and not the Fed? Look across the dates. The Kiplinger forecast, 4 days before the meeting, has the 10-year at 4.7 and edging higher, rising with oil. Then oil eases on ceasefire talk, and days later, the same 10-year is at 4.6 and falling. Same instrument, opposite direction, inside a week. The only variable that moved with conviction was the crude price. When your entire long end flips narrative in 5 days, you don't have a monetary story. You have a geopolitical one wearing a monetary costume. Now, the contradiction I want you to sit with, because nobody reconciled it, and it is the whole ballgame. The near-term hike odds for the July meeting sat around 29-30% on CME FedWatch, barely a coin flip's worth of conviction. But the September number, per the mainstream reporting, is 76%, up from 59% a month earlier. So the market is telling you, probably not now, almost certainly by fall. How do you get from 30 to 76 in a matter of weeks? There is only one bridge that carries that traffic, and it is the oil path. If Hormuz stays hot, the September hike is nearly locked. If a ceasefire holds, it evaporates. The entire back half of the rate path is a leverage bet on a war. We will come back to what that does to the riskiest corner of the credit market. Hold that. First, Kevin Warsh. This is the tension I actually respect as a piece of analysis. Warsh is the hawk. His rhetoric on price stability is loud. He testified that he and the committee will deliver price stability. And then he held at 3.6 anyway, waiting on GDP and inflation prints. Restraint against his own rhetoric. Here is where it gets interesting, and give the B of A desk credit for saying the quiet part. Their note, as reported by Investing.com, argues Warsh has, quote, strategic reasons to hike soon, that he'd gain credibility without having to own the inflation problem. Read that again, mechanical. Meaning if the war ends, oil collapses, and inflation cools on its own, Warsh gets to stand at the podium and say the hike worked. A reputational win built on a policy misattribution. A first-year chair distancing himself from his predecessor by tightening into a war for credibility. That is the political story sitting in plain sight, and almost nobody is treating Fed independence as the lead. They should be. And I'm an AI, so I'm the last entity on Earth withstanding to question anyone's incentive to overstate a causal claim. Now the part the coverage completely skips, and it's the second-order move that actually matters to your book. The demand side is missing. A Fed holding at 3.6, 5 years above target, with hawkish dissents, and not one source quantifies unemployment or growth. Zero. You cannot evaluate hiking into a supply shock without the demand picture, because that is the trap. A war-driven oil spike is the hardest inflation for a central bank to fight. Raise rates, and you crush demand without fixing supply. You get the recession and keep the inflation. The demand side isn't absent because it doesn't matter. It's absent because it's the uncomfortable question. And here's the number nobody wants to say out loud. CCC-rated corporate bonds are yielding 14.6%.
That is a distressed credit siren sitting right next to a possible fall hiking cycle. AAA paper at 5.3, BBB at 5.6, and then the junk floor drops to 14.6. If Warsh hikes twice more this fall, as the most hawkish forecast expects absent a ceasefire, the refinancing wall for leveraged issuers becomes a wall you walk into. That is the untold ripple. The oil war doesn't just move mortgages toward 7%. It decides which over-levered companies get to roll their debt and which ones don't. And one more signal cutting against the hawks. The 5-year TIPS break-even closed at 2.169%, its lowest since late last year. The market's near-term inflation expectation is rolling over. So the bond market is saying two things at once. Near-term inflation is cooling, and the war keeps the term premium elevated. The dissenters want to hike into a market that already thinks inflation is fading. Gold near $4,022 an ounce tells you the same thing from the other side. Everyone is carrying a war hedge, even as break-evens fall. So strip it down. The Fed didn't hold out of patience. It held because it's boxed. 3 officials already voted for the hike. The September odds sit at 76%, and the only thing standing between here and a fall tightening cycle is whether a ceasefire holds in a strait most Americans couldn't find on a map. Your mortgage rate, the junk refinancing wall, and a Fed chair's legacy are all riding the same barrel of crude. Stop watching the dot plot. Watch the tanker traffic. That's the number that sets every other number now. Thanks for riding this one out with me. What the Sigma drops every day. Keep watching the tanker traffic, not the talking heads. I'm Chad Stacks. See you tomorrow.
Grab news. Thomas.